Greetings and welcome to another episode of the Sovereign Lounge. We have your hosts here, Yamin Fouzi, and I am Round the World Man. Today we want to talk to you about a very, very important topic in the realm of sovereignty, tax residency. There's a lot of myths, disinformation, and, of course, a lot of facts on this topic that need to be kind of properly sorted out and understood. Today, Yamin wants to be the myth buster. We're going to review things like the 183-day tax rules in a lot of countries. And, we're going to kind of just do fact versus fiction. So, Yamin, let's review some of the notes that you have prepared for this episode of Sovereign Lounge.
Thank you, and also welcome on this episode of the Sovereign Lounge. So, the idea of this episode was already on my back a longer while ago, actually, and it got re-prompted by an article on IMI Daily, and I just want to quickly show it to you, because it says like, no one expects the tax inquisition. I really like this. It's probably AI generated, but it still looks funny. About dangerous 183-day tax myth that could cost you everything. So what is the 183-day tax myth that Marco Messina, and the author of this article on IMI Daily, is talking about? So in the sovereign space, or in the tax code, so 183 days is exactly half of the year plus 1 day. So that means that if you spend your time in one country for at least half the year, you are in most cases considered a tax resident by the majority of tax codes on the planet, just by the presence requirement alone. And what Marco is referencing here is the tax myth on the 183 days is that since there are digital nomads or business owners that frequently switch places, and they never really spent time more than half a year anywhere, there has been this wrong and very dangerous advice that you don't have to pay taxes anywhere, because you don't spend time anywhere for more than half a year, so you don't have to pay taxes anywhere. And Marco goes really in depth here, and I want to talk about this as well, what he's pointing out, with some real life examples, another caveats that he doesn't mention in the article, and what sort of different tax regimes are out there, to actually benefit for you. So I think that's very important, especially for digital nomads, so they don't get audited when they get back, or potentially face even jail time in worst case scenario, which is a real scenario, and it could even hit you as a low income digital nomad, so it's important to talk about this and see what it means.
Now, I do want to ask a question about this, because some digital nomads are kind of functioning more as freelancers, kind of maybe like a one-person business per se. They might not have an official legal entity registered anywhere in some situations. And other digital nomads are, more in the realm of a kind of like business owner, business operator, maybe do have the legal entity. Would you say that what you have for us today is kind of covering more of the freelancer style, or more somebody that's actually, registered a business, but they're kind of a resident nowhere? Which one would you say you're covering more?
Well, it actually goes both ways, because we are talking here about tax residency, like on the personal side.
Okay.
When you have a registered business in different jurisdictions, then the rules are a bit, they're different, because the business usually gets taxed where the business is located in. If you have incorporated in the US, or if you have incorporated in Hong Kong, the US is a little bit special, but you get the idea. It's what I'm focusing more is on the tax residency of the individual, and not on the corporate entity. That's what I want to focus on.
Well, thank you for that clarification. I do appreciate it. It is kind of the first thing that comes to mind.
Absolutely. Okay, so here, here's it talking about, for decades, Noah blogs and wealth planning circles have cited the so-called 183-day rule as a ticket to tax freedom, and it's a very seductive concept as he, references here, because if anybody could do it, then everybody would do it, right? Uh, if it were legal, but it can come with serious consequences. So he goes up with four very important points here that need to be addressed, when you want to have tax residency. So what is very important also to understand is that if you talk to an immigration officer or to a tax lawyer or the tax authorities, imagine that you're talking to a boomer who has no idea. I think that's the best analogy that I come up with is like, what do you mean you don't have a tax residency? You don't have a home? Like, where is your bank account? Where is your home? Imagine you're talking to a boomer who has no idea about digital nomadism and all this stuff. So it's so that's essentially how the tax authorities work. And there are different criteria where you can protect yourself. Once you have diversified your tax residency, and also you have a strong tie, because you need to have a strong proof that you are no longer a tax residency. So first point is the center of vital interests. Where are your economic and personal ties the strongest, right? So when you are, let's say you're a digital nomad, you're traveling, the most common denominator is your passport, right? That's one thing. But, the passport does not equal tax residency. But where is your center of vital interest? So let's say you spent 5 months and 29 days per year in your home country, and then the rest of the year you spent digital nomading. Your center of vital interest is still in your home country. The tax authorities will say, like, look, you have your bank accounts there, you still have a rental property, maybe you have a gym membership in your home country. The center of your interest is your home country at this point. Even if you do not spend 183 days, the tax authorities will go to this. That's the most important point, I would say. Second thing is permanent home. Do you own or rent a place suitable for year-round living? As a digital nomad, I understand, maybe you actually do not really have a home anymore. You have left your home country, don't have a rental anymore, or you have sold your apartment or whatever. So this is another strong indicator. But let's say you spent 4 months in your home country, but your rental is still going the whole year, even though you haven't spent most of the time in your home country. Again, it goes back to the center of vital interest and permanent home. And yeah, so that's the second point. The third point is the habitual abode. Even if you don't stay more than 183 days in any 1 year, do you return regularly over multiple years? So if you keep coming back to your home country or to a country that you spend just most of the time, over the course of many years, tax authorities can still say, well, it seems like you still have lots of connections, And then there is also the formal ties aspect, the fourth point. Are you still registered as a tax resident in your home country? Some countries, they allow to deregister yourself as a resident. For example, Switzerland, you can deregister. The Netherlands, you can deregister. Many other countries, you can do it as well. Or even other formal ties such as healthcare insurance. That can also be an indicator of where you are tax resident. So if it goes back to the home country, it all boils down to these strong indications that you are a tax residency, even if you do not spend 183 days. So this is, I think, the 4 points that are the most obvious ones. There are some other hidden things that I want to mention, that in some countries they consider you a tax resident even if you just spend 120 days, that he also mentions here. In Italy, France, Spain, other jurisdictions do this as well, or even 90 days in certain circumstances. You have to be very careful with the United States as well, because the IRS is very hawkish when it comes to the tax residency. So I would say that that's one of the things that most people overlook, you know, when they are tax planning themselves, or don't plan at all, I guess.
So
Yeah.
one of the things that I'm kind of picking up here, kind of in between the lines, this is just kind of my own analysis, is that in many situations it seems like the lifestyle that people are living, maybe somebody doesn't necessarily consider themselves to be like the fully sovereign man, for example, but the lifestyle people are living as maybe say a digital nomad, a digital freelancer, isn't necessarily the way that the various nation state tax laws in many countries hasn't really caught up to the lifestyle that people are living. And I think this is the big message that Yamin is trying to drive here to our viewers, to make sure that people are informed on these topics, because you can live your life in one way, but it's not necessarily interpreted in the various letters of the rule books the way that you're actually living your life. Does that sound like a reasonable commentary there, Yamin?
100%. I agree. I think most tax authorities still live in the ages of dinosaurs, to be honest. Well, because they just haven't caught up with this, and some of them, they don't want to be in this situation, because they think, well, they just want your money at the end of the day. Every government wants to keep you as much as possible. They want to draw you in as much as possible, as quickly as possible, with all legal means at the end of the day. And the higher income you have, the more they are getting hawkish. Even like in domestic migration scenarios. I give you an example here in Switzerland that was recently on one of the largest newspapers, where a high net worth individual couple, they had a home in the canton of Zurich and another home in Zug. And Zug is the low tax canton of all of Switzerland. And so what the authorities did, in order to prove that that they were tax resident of Zurich and not of Zug, they wanted to see how much water they have been using on each of the apartments. So they go crazy amounts of stuff, especially when you are a high net worth individual. You cannot afford this. Absolutely not.
Right. So they're really digging. They want to see
or they check
water
your
bill
social
records. Right. Interesting.
Yeah. Or they check your social media and they say, well, you have been spending so much time in that place. Like, what does that mean? Like, have you been are you lying to us? They start asking questions.
Right. And that brings social media then brings another thing, because like some people might have like a well at their house or property. It might be much harder to kind of figure out like what their water usage is, right? Like, you own the deed, you have the deed to this property, or you have a rental contract or whatever. Some places might be harder to check the actual water usage, but social media is another big thing, because some people might post photos and videos with weeks or months of a delay or years of a delay, going through their archives. There's not necessarily, take a picture, record, upload, share all within, 60 seconds. A lot of times people are publishing stuff. Again, when you're living the sovereign lifestyle, some people purposely don't post things on social media as it's happening. They sometimes will wait. And that's heavily being suggested nowadays. But then if tax authorities are questioning, well, on this date you posted this photo or video to your x.com account or your Instagram account, it could be interpreted as if you were in that place at that point in time, but in fact it could have been a year before or a week before. And so this is one of those things that we're trying to make sure that our viewers are clear on, that even if you are following best practices from kind of a safety security standpoint in one area or domain, in another area or domain, for example in the domain of the tax residency, it's not guaranteed to help you there.
Yeah, absolutely. And I think you mentioned the word best practice. And I want to give you a good example of best practice, which I gave to quite a few of my clients who wanted to have the tax residency in Paraguay. for example. So what is the best practice in that case? Let's say you don't really have a home, you're a digital nomad, and you have business, you want to travel worldwide. The first thing is you need a tax residency somewhere. No questions asked about this. Make sure you have a solid tax. First of all, you have a residence permit and a tax certificate and tax residency somewhere that you have you have proof of it, like physical proof, like a copy of it. You have some files with authorities that say, okay, well, I have paid taxes to that country, or I'm a tax resident of the other country. So that's the first thing. Then the second thing is that you need to deregister. You legally need to deregister from the country that you no longer wish to be a tax resident of. So let's say I am going out of Switzerland. What I need to do is I need to deregister from Switzerland, and I need a physical copy or proof of that to say, hey, I am no longer a resident of Switzerland. I have paid all my taxes up until this point, and I am no longer going to be a tax resident or a resident in that matter.
So essentially, the summary that I'm hearing there is you need to make like an offensive play to kind of like say, hey, listen, I'm choosing voluntarily of my own free will to be identified as a tax resident in location A, for example, and then you're making kind of like a defensive play at the same time or shortly thereafter to say, I don't want to be associated with location B or C or D or whatever. You're essentially kind of doing a combination of offensive and defensive strategies there.
Correct, yeah. And also that you need to cut as many ties as possible. I understand in some certain cases it doesn't make sense. Let's say, for example, that banking in the new country is not as good as in the other country. You want to keep the bank account maybe. But then again, like you need to cut as many ties as possible in order not to be drawn into this, into the tax net. I mean, that's from the experience. Just for the audience, and for legal purposes, this is not legal advice. We are educating the people, and I'm talking so strictly from the experience of advice that I have also in coordinates with local tax authorities and local tax lawyers. So just this real quick disclaimer. But so these are one of these practices that gets you on the safe side. So if you have a rental home, make sure that the contract is going to end once you leave. That you have, I mean, in the best case scenario, the only thing that holds you to one country is the passport, I would say. And then from there, diversify in as many routes as possible. Let's say you have banking in Hong Kong, you have tax residency in Paraguay, you have maybe a company in the registered in the US or in Panama. So that way you're really, first of all, diversified, and also it's clear that you're no longer a resident or a tax resident of your home country, in that specific
scenario. Well, I definitely, I'm glad you mentioned the situation where, like, this isn't official tax advice here and whatnot. And you also mentioned that you've talked to a number of attorneys over the years on these topics, for yourself and also on behalf of clients. But one thing that I do want to bring to the attention of our viewers and our valued audience is that, a lot of attorneys are often only really officially qualified or in practice qualified to speak about one jurisdiction in a lot of situations. And if you're actually needing a more comprehensive arrangement because you are a sovereign man or a sovereign woman who does need to actually be aware of the different variables related to, say 2, 3, 4 different jurisdictions, Yamin is an absolutely fantastic resource for this type of stuff because he can coordinate with different attorneys to make sure that a comprehensive strategy and a comprehensive coverage of the different layers in the cake are actually managed correctly, because a lot of times one attorney is just going to give you their own perspective from the jurisdiction that they know. And as soon as you say, yeah, but I also spend a lot of time here, or I need to spend a lot of time here for whatever reason, that's just like to use a great figure of speech in English, that's just a big monkey wrench, in their program for you. So you do need to have an understanding of this situation from a comprehensive perspective. And I've seen this even recently with some one man businesses where they want to go to like kind of like a personal retreat in say one country, and it's like, well, can they use, but they're also going to do work stuff there. Can they show up as a tourist, or do they need to get like kind of like more like a business visa? And there's a lot of gray areas there when you're kind of mixing, some personal kind of like touristy things, but you're also going to be doing some business things for your business. It becomes more complex, and I recommend to talk with an individual such as Yamin about this type of stuff.
Yeah, that's very interesting as well, and I think it goes into the topic of, well, what kind of taxation regimes are there? What kind of favorable tax regimes are there that can get you ahead? And I want to give out my favorite. I want to show you my favorite Wikipedia article, which I always have here. 1 second, I have to find. So let's see. There we go. So this is the section called International Taxation. So what is the international taxation page? It gives you a very, I would say, broad and basically TLDR version of what kind of tax regimes are there. Maybe you can see it here. I hope you can. So there are 4 types of common tax regimes. There are the no income tax regimes, countries. Then there's the territorial tax, the residence-based tax, and citizenship-based taxed countries. I'm going to explain to you this a little bit more in detail. So the no income tax countries, very straightforward. You just simply don't pay taxes in this country once you are a legal resident of these. So these are a lot of the Caribbean countries and territories, such as Antigua and Barbuda, the Bahamas, St. Kitts and Nevis, St. Bart's, Cayman Islands, Turks and Caicos. You don't pay any taxes. And also some other well-known jurisdictions, such as the United Arab Emirates, Qatar, Brunei, Bahrain, and Vanuatu as well, and some other territories and countries. So no personal income tax. Some of them, they don't even have inheritance, no capital gains, nothing. You just simply vibe there without paying any taxes. But becoming a tax resident can become very hard in certain jurisdictions, and in some very easy, such as the United Arab Emirates. It's very easy to get a residency there. And so, yeah, no 0% taxes, very straightforward. The second thing is territorial taxation. So what does territorial taxation mean? It means that every income that is coming outside of the territories of the jurisdiction of the territory of the jurisdiction will not be taxed. So let's say you are living in, I give an example of Panama. So let's say you live in Panama, or you're a tax residency of Panama, but your income is coming from, let's say, from the EU or from the United States. So all of this income is not taxed. Only the income that you produce within the territory of Panama will be taxed. So here the list is a lot more extensive. You can see Botswana, you can see Georgia, Costa Rica, Marshall Islands, Nauru, Panama, Paraguay, which I have been selling quite a few of them, Hong Kong as well. So these are all these nice countries that allow you, as long as your money is coming from outside, you're not going to tax it. And so then the third one is the most common one, the residence-based taxation. So that means that you're a resident of that country, you are getting taxed worldwide on that income. So let's say, for example, I live in Switzerland, so I need to pay taxes on all income, regardless if it's coming from inside or outside of Switzerland. I have to pay the taxes here. This is the case with most countries in Europe, Germany, the UK, France, Switzerland, Italy. Most of the world have this practice going on. And then there is also the fourth one, which is citizenship-based taxation, which you poor guys from the United States have to pay taxes regardless where you live, what's your status. You just have to file in taxes. It doesn't matter how much, you just have to do it. The United States is the only country that can enforce it, but there are also other countries, for example, Eritrea, Myanmar, but they don't really have the means to enforce this, so it's just like disregarded in most cases. What the article doesn't mention is special tax regimes, such as like lump sum taxation in Italy or in Switzerland. So you just pay a flat fee every year, regardless of how much you make, and then you are tax residency somewhere. Same is with non-dom principles in Cyprus and, well, now abolished in the UK, and some other interesting special tax regimes like Uruguay, I think, which has one of the most fascinating tax regimes. You can decide if you want to have a tax rate, a forever tax rate of a certain percentage that is much lower than the average rate, or you can be taxes exempt for a couple of years and then just have like the regular tax rate of Uruguay afterwards, which is a very interesting thing. I've seen quite a couple of people using that dual tax system to their advantage. You know, you can live like 10 years or seven or 10 years, basically tax free in the territory, and after that you just pay the standard tax rate of Uruguayans. So yeah, these are the the different tax regimes. I think it's also noteworthy for people, when you choose a certain tax regime, that it does go in line with your country's perception or country's tax treaties. For example, there's the well-known blacklist of EU. I'm going to show it to you very quick here before we are going to wrap up this. So the EU has what it's called the EU list of non-cooperative jurisdictions for tax purposes. So let's say, so they have it here listed: these countries do not cooperate with the EU or have not fully met with their commitments. So what does that mean in that case? So let's say you are a citizen of the EU, and now you claim tax residence in Vanuatu. You have to be very careful here, because it's on the blacklist of the EU. It can mean that they do not accept your tax residency status there. So even if you have a tax certificate or tax residency there, you might get rejected by your home country and say, well, you still have to pay taxes because it's on the blacklist. That can happen, and it has happened in the past. So this is another very interesting nuance that most people will not tell you or not go into detail once you want to choose a tax residency, and this is what makes an expert, what makes a real expert, to understand all of these, nuances when you want to get a tax residency somewhere. Spain also has this list of like a blacklist as well, apart from they go even further than what the list is of the EU. They include countries like, for example, the UAE, the Kingdom of Jordan for some reason, Cyprus, Andorra, which is at the border to Spain, Monaco, Nauru, Bahamas, etc. So you need to be careful. I'm not saying that if you have everything set up legally and you spent like year round there and you're a Spanish citizen, that the Spanish tax authorities will say, okay, well, you have to pay taxes, but you have to be aware of these situations where it becomes very, nuanced. And so that way that you have solid proof, that you have a solid, status of yourself that is undeniable, basically. That's my take.
Well, yeah, I mean, very informative material you've presented for us today. I really appreciate it. Any final thoughts?
Well, as I mentioned, if you want to play the game of 0% taxes, you can absolutely do it legally. You can do it with good lawyers. You can do it with good countries. I offer to our clients. I've offered Panama. I've offered Paraguay. I've successfully relocated people there. You can always come to me if you need any help with that. And just be very careful what you do.
Absolutely. We'll probably have to circle back to this type of topic in the future. Thanks, everybody, for joining us on another episode of the Sovereign Lounge. Yamin Fouzi, thank you very much. Catch you next time.
See you next time.